Ladies and gentlemen, good afternoon. We have a remaining activity here this afternoon, which is an attempt by virtue of an extraordinary panel of experts to parse the systematic forecast. Let me say a little bit about that. I want to, of course, introduce the panel, and we will get right to it. As you well know, there are many methodologies for forecasting economic activity, and those methodologies are evolving over time. The primary methodology, the methodology that's employed here at UCLA and in the Anderson School, is one of tracking a very large number of economic indicators and statistically evaluating those indicators. I happen to have spent many years at the Federal Reserve and on the Federal Reserve forecast team prior to coming to UCLA. And what we did at the Fed was everything we do here at UCLA and at the Anderson School, but we did something in addition to that, and something that we're going to do right now, which is that we called, once we had formulated a forecast at the Fed, we called the captains of industry. And we asked those captains of industry to reflect, to nuance, to interpret the numbers that had been derived at 30,000 feet via statistical series by way of their experience in the trenches. And that's exactly what we want to do with the experts that are here today. And that's exactly the question that I'm going to ask our panel as we begin now. We're going to ask them, gentlemen, to please, from your own perspective, from the perspective of the business unit that you run, from the perspective of the indicators that you personally track that are pertinent to your line of work, to reflect upon the generalities that were provided via the macro forecast. Before you do that, let me introduce you. Peter just spoke, and Peter, thank you, extraordinarily interesting, and I'm not sure Peter needs further introduction, the co-CEO of Westfield. Next to Peter is Mark Forbes. Mark is Executive Vice President, member of the Executive Committee, and manager of the Real Estate Division of City National Bank. Next to Mark is Wayne Brandt. Wayne is Managing Director and National Originations Director of the Real Estate Capital Markets Group at Wells Fargo. Then comes Brad Cox. Brad is Senior Managing Director at Trammell Crow. His responsibilities for capital raising, investment strategy, deal flow, and day-to-day operations of the LA office. And batting cleanup is John Tipton, operating partner of the Century City office and immediate past chair of the real estate department of Allen Mackins, with very deep expertise in real estate transactions of every sort. So gentlemen, before you answer the question or address the question that I just spoke of, let me perhaps try in just a sentence or two to encapsulate what Ed and David and William and Jerry spoke of this morning. They spoke of labor markets that are going to remain tight. They spoke of an unemployment rate that they expect will remain in the 5% range and near what we believe is full employment and the natural rate. They alluded to ongoing seriously low productivity growth and muted overall GDP growth. GDP growth that they see coming down into the range of roughly 2%. Ed spoke of this perhaps as something of a new normal. They also alluded to the specter of inflation, and we see that inflation already in labor costs, but they expect to see it in the CPI as well. And with that, Fed tightening, and so if you look at the projection of the funds rate, we see a funds rate going out through 2017 to about 3%, an inflation rate of roughly 3%. And the hope, as Ed indicated, that this tightening will not result in an inverted yield curve. So we're hoping at the same time that we see this expected inflation, that we will see a strengthening of economic conditions abroad that will allow the Fed to tighten, but yet for the yield curve not to invert. So that's kind of a very quick review of what we believe the forecast is. We believe the last month's employment number was an aberration. So with all of that, Peter, maybe we'll save you for cleanup because you were just batting there. We'll start at the end with John. And let's just work our way down the line and just, if you would, reflect upon the forecast.
Sure. Well, one of the things Jerry Nicholsberg talked about was we have and have had for about the past decade a survey and index with UCLA Anderson Forecast, which measures different product types, 6 different markets in California, and then the product types of office, retail, industrial, and multifamily. Jerry focused on what was kind of a bit of the outlier, and the one that certainly caught our eye this time which was the Northern California markets going a bit negative. And that was really the first time we've seen that happen since, of course, the Great Recession. Perhaps not completely surprising since Northern California kind of led out of the recession and really was the first to recover. I just wanted to speak a little bit about what we saw in the rest of the survey results. And again, San Francisco, East Bay was really the only place where sentiment went below the 50%, meaning going from optimism to pessimism. But what we did see, taking first in retail, was a tempering of optimism. Not that optimism was that great at this point in the cycle, even before, but a little more tempering of the optimism, but still optimistic. Industrial, a little more choppy, if you will. Southern California remaining strong, perhaps explaining Dick's record stock price today. Northern California, still optimistic, but coming down lower. And then really, the one silver lining that was nice to see, and perhaps not that surprising, just based on kind of what we're seeing in the firm and the activity, is the multifamily. Multifamily in the Southern California markets, there is actually an uptick in optimism. And again, as Jerry mentioned, this survey is designed not about what do you think is going to happen in the next 6 months, but what do you think is going to happen over the next 3 years. So there was really continued long-term optimism for Southern California multifamily markets. The optimism rate, again in Northern California, fell more so, but remained in the optimistic sense. And I'd say that's fairly consistent with what we're seeing in the firm. I'll talk a little bit more in detail about that later.
Thank you. Brad.
Stuart, I'm a real estate developer, so I think from our perspective, the forecast was totally off base. I think you, and Alex, you're okay. I'm not going to go hire a robot, so I think I've got Alex Valente who works for us out here. Now, I think you have to, if we look at it across the United States, the Trammell Crow Company has about 15 offices. We currently have about 133 projects that are either in progress or in our pipeline. From a total volume standpoint, it's about $3.3 billion in the pipeline, about $6.8 billion in progress. Real estate development being a market-to-market opportunity, when we look at certain markets across the country, there is concern. We are looking at, we feel very strongly that the market has a lot of wind through 2018, maybe even early 2019. So we feel good about where we are in our pipeline and in progress developments, but there's a lot of concern at our senior investment committee level to make sure that we complete those projects on time, on budget, get them leased up, stabilized, and exit before we hit mid-19 or moving into 20, because the uncertainty in the job market is of utmost concern. When we look at it locally, we feel very strong about the Southern California markets. We feel very strongly about Northern California. We think the job growth dynamics are good, in particular in Northern California, and we believe the dynamic in Southern California is all built around the entitlement challenges that we have because of California CEQA, a very organized local neighborhoods, and to the extent that you can get any product entitled in Southern California, it puts you in a very strong, favorable position to put debt in place to exercise the vertical development of that product type. So we're feeling good through 17 and 18. Again, concern about where we are and what your forecast, and we can talk a little bit about how that really flows down into the various product types a little bit later.
Thank you. Wayne.
Sure. Good afternoon, Stuart. Thank you for having me on the panel. It's great to be here, always at UCLA. Look, I thought the economic forecast was very realistic, but I just add, I think you all should borrow more money, though. That's the one caveat.
We can talk about that.
But anyway, I'm going to start with Dr. Lemer's comments because I think they're spot on and they parallel what our chief investment strategist is kind of his message, and that's Dr. Paulson. And his view, it's all about demographics and it's all about productivity, and the boomers are not booming, so that's why our productivity rates, that's one of the explanations why we're maybe not as productive, and we have a very low labor participation rate. So all those themes towards slower growth, and he cites the statistic, which may dovetail with some of the slides that we saw earlier, that when you get to full employment, a recession statistically occurs 1.77 years afterwards. I'm not sure how he got 1.77, maybe 1.78, but he's an economist. So that's where Wells Fargo is kind of thinking about some of these larger demographic trends and its impact for slower growth. So how does that impact what we're doing in commercial real estate? I would say a couple things. Fundamentals, I think you all feel in most of your markets, fundamentals are intact. I mean, if you look at the expected rise in NOI this year, on average, across all product types, it's going to be about 3%. Multi is probably about 5%. Storage about 5%. So our fundamentals are reasonably intact. We haven't built a lot of product. And then on the capital market side, we still have tremendous capital flows. On the equity side, over last year, I think for 2015, total equity flows, all investment activity was up 23%. So we're feeling some stress in the debt market, which we'll get into. But we're also seeing, as I go out and talk to our borrowers and our brokers, the view is that the word I would use is cautious. And values are maybe not falling, but the rate of value appreciation is decelerating right now. And so I think that's what we're feeling. So then lastly, how do we translate that into kind of our behavior? Probably Mark's the same way, how we're underwriting, how we're looking at risk. I would agree with Brad. I think we're all looking at 2018, 19, and 20 as a slowing, maybe not a recession, but when we underwrite a 3-year bridge loan, we have to be very, very pathological about how we get paid back and where the economy is going to be. So that's why you're seeing some of the underwriting getting a little more conservative, a little pullback on multifamily lending. We've done a lot of construction lending as an industry. So these are the things that are translating into kind of parts of the forecast into real action that I'm kind of seeing day to day, a little cautionary from the private equity funds and lending as well.
Yes, Mark, please. Thank you, Wayne.
Unfortunately, you got two bankers back to back, and we're probably not going to sound a lot different. I heard a couple things today. I heard Peter say that, and I think we'd all agree, everybody here is here, I can assume, in real estate. Debt capital and equity capital are keys to making the machine work. And when you couple a weakening economy that we heard from the panel of economists, Wells Fargo's economist, what we see is a slowing economy, add tech disruption, which is causing uncertainty, changing certainly the retail face, which we know about, changing office and how it's used. Add to that regulatory pressure, which we can talk about later, but you've all heard about, both on capital in the banks and compliance in the banks. And then probably the last thing is over the last 3 or 4 years, the banks have loaded up on real estate because they haven't had other places to put their assets. This country used to be filled with manufacturing, and the banks could do inventory and receivable lines and put capital out. Those have gone away largely. So besides the multinational banks, which can move capital around better than the local banks like City National, well, we've got to put it in where there's demand. And the demand's in real estate, and yet from a management perspective and from a regulatory perspective and from a safety and soundness perspective, how much real estate are you going to do? So you look at all the banks in this country, and they're all, take away the biggest of the banks and put them in a different group for a minute. The rest of them are largely at capacity in what they've been doing, and how much more real estate are they going to do? We need a CMBS market that's more active. We need better clearing on this stuff, and I think we're going to see a tightening of debt from a capacity, a sense of increased risk tightening. Increased pricing is going to come with that. That also goes with the capital. So all of those together with the weakening economy says debt's going to be a little harder to come by, and it's going to feed into a slowing in commercial real estate.
Thank you, Mark. Peter?
I think the one thing that surprises me is the forecast of 3% inflation. It's the first one I've seen, by the way. And I mean, from where we sit, we don't see it. Unfortunately, in our business, part of what you see when you see internet sales increasing and retailer sales flat or decreasing, and maybe we should do a study on this, is that over the last 5 years, we've seen deflation in the price of products that we sell at the mall. And I can't tell whether there's unit volume increase, and because of the deflation, there's lower gross sales, or is it both? So I'm surprised about the inflation. I'm not sure I see as much pressure in wages as yourselves, but you guys have all of the data and you're the economists, but I just don't see it at the moment. And I think from the real estate industry, I like to tell things in stories. And I like to do projections in stories too a little bit. And it takes the real estate markets a very long time to adapt to changes in the cycle. And I'll give it to you this way. We happened to have be the fortunate people that opened up Westfield London the day Lehman's collapsed. It was a beautiful thing. We had a £1.5 billion mall, and somebody from the Guardian newspaper who was very sceptical about the mall. In fact, the headline was "White Elephant Behemoth Ode to Another Era." Thing only does 1.2 billion pounds of sales, so they asked me. The interviewer asked me, "How can you be so stupid as to open this mall the day Lehman's collapsed?" We started that mall 10 years prior to the day Lehman's collapsed. So I think when you look at most of these real estate projects and you look at the projections that you have and you look at the cycle, most of the long-term investors, especially with REITs today, actually invest through the cycle into the next cycle. So that when you look at real estate prices moderating somewhat, for most of the investors, that's okay because they're investing through the cycle. It just depends where they are in the development phase. I think the last thing is that when you look at most real estate companies today, they are way less leveraged than they used to be. So the change in values and the change in the economic cycle affects them less.
Okay, excellent. Thank you all. I'd like to pick up on an element of Peter's presentation and also an element of Ed's presentation. One of the final charts that Ed presented pertained to an interest rate forecast and implicitly a yield curve forecast. And he's got a short rate, again, a funds rate going up to roughly 3% over the time frame of the forecast. And he's got a 10-year treasury, which goes up and then roughly comes down to in the neighborhood of 3%. So Ed, I'm not sure if you calculated the basis point spread there right at the end, but it looks to me just from the naked eye at something like 50 basis points. So what you see is, over the period of the forecast, a real flattening of the yield curve. So the question for the panel, the question for all of us here today, is what is the implication of this rate forecast for cap rates, for discount rates, and for all of the pro formas that you all look at in all your projects? And Peter kind of laid out this particular question when he talked about the idea that risk-free rates can go up and cap rates can go down. And of course, implicit in that particular discussion is a contraction in risk premia. Now, Mark and Wayne just said that, oh, by the way, risk premia may in fact be going up. And so, gentlemen, Mark and Wayne, you have both suggested to us that you think we are moving into a world of higher cap rates and higher discount rates with attendant implications for property valuation. So maybe if you could, members of the panel, speak, if you will, to what you believe will be the direction of what are currently relatively wide risk premia embedded in cap rates and discount rates, where you think those risk premia are going, and hence what are the implications for cap rates, discount rates, and property valuations. And any of you can take that on.
That's a lot. But,
Sorry.
you know, I think simply put, I think we've seen valuations rising at a rate that they can't, the rate they've been rising cannot continue. Right. And so there has to be a leveling off. Now, whether it's going to be a down or a leveling, every time in my career that we've thought there's going to be a leveling, It's, oh, by the way, you forgot about that one black swan event and it's a big down. But without the black swan event in there, you can't assume that you're going to have value creation here, except where, like you're doing, changing the model to create it. Just the simple fact of investing and benefiting, as Bill Gross did for years of a declining interest rate environment, is no longer the game.
Okay.
I think I think there's two issues. One is we all forget that the 10-year Treasury in 2013 was at 3%. And if it goes back to 3% for our industry, it doesn't, depending on the spread, it doesn't really affect you. And I have this theory, I owe Wayne a bunch of money here, so I've got to be a little careful. But every time we go to the bond markets, when the market doesn't fundamentally believe the 10-year Treasury, sorry, there you go, someone's telling me something, or it's too low for the return that the investor needs, the spread just widens. And while theoretically the spread is the risk premium, I actually argue it changes depending on where the Treasury is. And every time I've seen the Treasury at, we borrowed it, when it was 255, we borrowed at 120 over. When it was 3, we borrowed at 90 over. When it was 170 or 180, we borrowed at 190 over. There's a minimum return, I think, that the bond investors are prepared to accept for putting their money out for a long-term period. And I almost think that the Treasury almost doesn't matter to that.
Okay, very well.
It's not a rigged election and not a rigged convention, but it's a market.
Just to build on a little bit what Peter's saying, because I largely agree. And if you just look historically, you go back to 93, 94, and then 2003, 2004, were kind of the last periods where we had a little bump in interest rates and the Fed moved it up. What happened 12 months later, to Peter's point, is that actually real estate values rose and REIT values rose as well. So that historically has kind of been proven out. Now, what's a little counter to that right now is the risk premium that the fixed income markets are requiring to price real estate risk. So there's an absolute rate of return that they want to achieve. Investors still really like the value or the relative value trade of investing in CMBS or a debt fund investing in construction mezz, but they really need to get paid right now. So the risk premium has moved out. Yeah, I feel it. But cap rates have not really moved yet. So that's what's a little bit of the conundrum, which kind of would support Peter's point. But we're feeling investors. I'll sit down with AAA investors and say, "Are you going to buy?" Say, "Absolutely, we're going to buy because but we're not going to drop our spreads, really much more from where we are right now. We're going to, as to Peter's point, coupons are kind of staying the same." And as spreads, as rates have come in, spreads have widened out, and they've maintained their parity. So that's really where we are. And the other thing in the CMBS market is we don't have a lot of supply of bonds right now, so there is a liquidity premium that investors want to get paid. There's a risk retention, a regulatory premium investors want to get paid. So these are things that are a little, kind of off the grid. Exogenous variables are not showing up in the economist forecast, I think. But
no, I mean, there's a flood of capital out there that's available for really high-quality assets. To acquire a great asset in a supply-constrained market where you can still get great yields, there's a flood of money out there. What we've seen since the first year is just what Wayne talked about in the construction lending market. The debt terms have changed dramatically. There's this viewpoint that
like no debt, right?
Like no debt. There's only a handful of banks out there that will lend, even in Southern California, where we have unbelievable dynamics in the multifamily market. There's only a handful of banks, of which Wells is one of those, that are willing to lend.
So is City National.
City National's still there. Spreads are
We're
pretty
both
high.
recourse, though.
Yeah. No, but it's the loan-to-value ratios have changed. The terms have changed. The Dodd-Frank regulations of January have to be significantly higher. We used to have a 12-page closing checklist with Wells on a deal that we're just closing next week. It's now 16 pages as a result of new regulations that came into place. So the difficulty in closing debt on a speculative construction project today becomes extremely difficult. And I can't put my arms around why, because
Yeah.
again, people are looking for yield. And you're looking to place capital.
That's a function of regulation, which I don't want to jump this. We'll come back to that, but I think it's a really important point. I can give some more color to that in a minute. And so
Why
can
don't we
Mark.
go there right now?
So,
Please.
okay, so what we're experiencing, what you're experiencing right now is it's changing banking behavior. The regulation is changing banking behavior. So, we're in the full throttle of Basel III being implemented, Dodd-Frank being implemented. Just to give the audience just a little, just a little background. So Dodd-Frank, its intended purpose was to prevent too big to fail. And that's everything under Dodd-Frank is pertaining to that goal and objective. Risk retention is part of Dodd-Frank. Over on Basel III, which is largely a voluntary set of guidelines, lending guidelines that International Committee of Bankers and Policymakers made back in, I think, 2009, were adopted by the Fed in 2011. They now go into effect right now. So what Brad's feeling right now is that he can't get a construction loan because the Basel III requirements are kicking in and crushing not only our community banks, regional banks, and a little bit of the big money center banks. So we're seeing a real reaction. And as I get out there and talk to the market, there's very little construction lending that's taking place. That is being fulfilled by the shadow banks, the debt funds. So risk retention is now getting implemented by year end, and that's going to add about 25 to 40 basis points to anybody borrowing in the CMBS market. That's kind of the projection right now. So regulation is changing behavior. And Mark and I are having to deal with it kind of every day in terms of costs and liquidity and disclosure and so forth.
Yeah, and they're good at telling you that it's a non-recourse loan, and then when you get into the carve-out guarantees, it becomes full recourse.
Oh, you read those, huh?
Okay. Maybe a follow-up here, and a follow-up that takes a little bit of a different tact, and a follow-up really for all of you, whoever wants to jump in. But I think David alluded to this a little bit in his presentation, and certainly Peter alluded to this in his description of the fact that Westfield's gone from, I think, Peter, you said 119 to 38 malls. 34 large regional malls. And one of the artifacts of this so-called recovery, as I believe we know it, is a real separation of A, B, and C geographies. Very different contours of recovery across these geographies. And I Brad, from a development perspective and from a lending perspective and a transactional perspective from all of you, what happens in these B and C locations? And play futurist for a moment. Does anyone want to say anything about the future of the suburbs? Does anyone want to say anything about the future of Exurvia? I grew up in one of those places, and we have Ed talked some about, and David as well, about disruptive technology. We're going to have a lot of disruptive technology that relates to transportation, that relates to delivery, that relates to how people get around. What's going to happen in these places? Are these places permanently dead?
Well,
Or on the other hand, is there equilibration ultimately as the century cities of the world just become too expensive?
Well, I would look at it that, I mean, you talked about it today, and the lack of manufacturing jobs in middle America. We've lost a lot of our middle class. So I'm not worried about the high job growth markets, the technology growth markets, places like Seattle, Portland, San Francisco, Los Angeles, San Diego, Austin, Denver. You go through those major job growth markets where technology is going to continue to thrive, that have great business favorable communities. There's a lot of great job growth dynamics about those communities. The second tier communities like Minnesota, Minneapolis is going to continue to do well. You look at moving into obviously Washington DC, but Atlanta is on a huge recovery and coming back now. So we're seeing those concentrations in those second tier markets where there are great technology based jobs that are going to continue to grow. They're not manufacturing based. The cities that I get concerned about are the middle American cities that were based upon large-scale manufacturing. Those cities are decimated, thus why Donald Trump is, resonating throughout the United States about creating more jobs. Those markets, long-term, I just don't see where the opportunities are. Cities like Kansas City, St. Louis, you're going to see great opportunity there as Google comes in and invests in the fiber optic technology in those cities. They're going to create great contract labor opportunities for the major employers like Dell and Google. Today, it's not necessarily about long-term employment for some of the technology companies. It's all about contract labor. So you can have a Google team that's based in Kansas City because of the quality of life that the young millennials like about Kansas City or Minnesota, and they can be working on a major project for Google in San Jose. They'll have a couple of Google execs that will move there on a year contract basis and run a team of 30 people. And so that market is changing the labor dynamics of employment in the United States. So those second tier cities are going to create lots of opportunity because of lifestyle decisions and will continue to thrive. But the manufacturing, as you talked about, those markets and cities, I just don't see where the long-term opportunity and growth for those cities.
Anyone else want to jump in?
Just on the retail end, we've sold a whole range of assets that are good assets in decent marketplaces. But the issue for us is the returns going back 10 years versus the returns going forward 10 years. I don't think those assets are going to go away. I don't think they're going to collapse. Our analysis is most of the ones that we've sold, we had a unleveraged 10.5 IRR going back 10 years. Our estimation going forward, it's somewhere between 7 and 8. And we cannot hold because of the return on equity that we have to produce for our shareholders. We cannot hold assets that have a 7 or 8 IRR, depending on your leverage, depending where you are. But we run on an unleveraged basis. So.
Okay.
Unleveraged, free and clear.
But the question becomes then, who does hold it?
So
Competing for the same
the beauty
capital.
about I have to be careful here because we sold about $3 billion of assets this way. But the beauty of the Fed and low interest rates is the buyers of these assets were funds who created, put together and raised institutional capital. The institutional capital, because of where the 10-year Treasury was at 2.5 or 3 or 170, is happy to have an unleveraged IRR of 7 or 8. But what they're getting is a running yield of 11, 12 or 13. Because we just sold a bunch of assets at a 7, 9 cap rate. We got it done December 17th, thank goodness. January 17th, you couldn't have done it because the CMBS market's closed up. They borrowed 58% against, it's got a 13 running return. But the capital you need to spend on the asset to keep the retailers there and keep the rents flat, or let the rents come down and look at the capital values of those assets will deteriorate. But the investor will get a 7 or 8 IRR at the end of the day and be happy to do so. So we sold them to financial investors who are looking for yield with funds who are looking for fees. Thank God for the United States Fed.
Okay, I know that there are probably many questions out there. Maybe I'll perhaps ask one more kind of very broad question, and we'll open it up a little bit. Peter, I was really intrigued in that portion of your talk this morning that talked about what I would call the sociology of the retail mall and where that sociology is going and how we understand ourselves as human beings and how that's expressed in from your perspective, a profitable shopping experience. And we can build on that to think about the sociology of our urban places. And again, to sort of think about the B and C places as well as the A places. And I'm just wondering also, gentlemen, to speculate, if you would, a little bit on urban futures. If you drive down to Irvine today, you don't see more single-family development, in part because we're land constrained, but you see an urbanization of a suburban environment with all of the urban amenities that we believe people are looking for in that suburban environment. And I'm just kind of wondering, I'm just kind of putting it out there as an extension of what Peter said. Are we going to change the residential experience in the same way that we're changing the retail experience? And are we going to change B and C places in the same way that we're changing Century City? And is that what investments and lending will look like going forward, or not necessarily?
I'm going to leave that to the bankers.
You know, we are there, we don't create demand, we meet the demand. So it's what can someone envision, the entrepreneurial developer out there, can they envision, get a community to support and create? I think, and you've got a much broader national scope, we're very much urban California in what we look at, but we see in urbanization, if for no other reason than the lack of public spending on transportation infrastructure is driving us to a point where you don't have a choice. No, we're not going to finance today, and I'm going to pick on an area of town, or of Southern California. We're not going to finance a tract of homes in Lancaster today, because there's not enough jobs being created there, and nobody's going to make that drive this cycle. They were doing it 15 years ago, but they're not going to do it now. And so that same millennial that would have been the buyer target for that home last time is not going to do that. They'd rather rent. At whatever expense that is, whatever change in lifestyle that means the wife's going to have to deal with the kids not having a backyard, whatever, but they can't do it. So that means that we're going to a different style of living here in Southern California because there's no way to get around town. And that is more dense, that is more urban, and again, that will create more opportunity. And then the B and C properties will become something else.
Okay.
I maybe take a little bit of a different view. So the thesis is, aren't we going to dense up and urbanize with all the millennial demand that's out there? People aren't going to drive cars. They're just going to become renters. They're just going to not own anything, store everything. And I think if you look at going back to demand and going back to the demographics of the millennials, so we have 87 million millennials age 18 to 34. The cohort right behind them is just about like 82 million. Now, and so this is where I depart from the conventional thesis right now, is that eventually, I just think it's delayed. So this is the 15-year vision. You asked about the future. So I can say anything. Nobody can hold me accountable, right? So over a 15-year period, I just think these millennials will want to demand things that they've been denied of. They're going to want life insurance. They're going to want good schools. They're going to want cars. They're going to want a little more land. And if we believe in the U.S. economy with moderate growth, that eventually those knowledge workers particularly will move into more of a suburban type environment. So in the short run, I really like the urbanization that's occurring in our more dense cities. You go to Austin, it's just awesome what Facebook and Google are doing downtown, Salesforce. But I think eventually, when you talk to these, and I have two millennials, and you talk to them, and the USC forecast, sorry to bring USC into this, but their housing forecast their survey was that millennials actually desire to own a home. Shocking. But that's what eventually they would like to own a home. That's what the survey statistics tell us. So that's a very powerful emotional need, and that's where over the next 15 years, I think it may take us back into the suburbs, but it's going to be a different format. So I'll let Peter tell us
if
how
they
we're
don't
going
have to commute to work. I agree. If they can work at home on their PC, that's great.
Yeah, but that's LA. But we're just talking about the general.
But the issue for a city is it's much cheaper for a city to urbanize than have urban sprawl.
Exactly.
You need less infrastructure, you need less investment, you make much more use. I mean, you look at the valley, even though Australia is a really large country, it's a really urbanized country. And when land is very expensive, people urbanize. Land in California, actually land in most parts of America, but land in California is really cheap compared to most parts of the world. And what's happening now is that cities cannot fund urban sprawl, so we're getting urbanization. You just have a look at Topanga down where we are in the valley there, and you have 2 or 3 story apartment buildings becoming 5. You have single family homes becoming multi-family homes. I agree with that. That trend will go for a period of time, and then the trend will change, just like everything else.
Yeah, I'm one of those. The millennials haven't really driven the urbanization. I think it's really the cities that have
I do
invested
too.
in the urbanization.
I do too. They've squeezed it
it's
back
just
down,
like-
not given approvals.
That's right.
Yeah.
And it's those cities, I mean, you look at San Antonio, I mentioned Kansas City, Austin is a prime example. They invested in their urban infrastructure, Portland, downtown, which then made it attractive for the millennials to move there. Downtown Los Angeles, our growth is being driven because we invested $27 billion in many infrastructures, primarily our transportation infrastructure in downtown Los Angeles. So that's what's driving that residential growth down there, because it provides an access point, as Peter said, that where you can get anywhere in the Southern California basin if you live in downtown. So that's the differentiator, and you can go across the country of Detroit that's now just in a rejuvenation, because Detroit all of a sudden there's money flowing in Detroit in downtown that's going to really help drive and change an eroding community. It's not driven by manufacturing jobs, because those jobs again are gone. It's, that's what we have to look at.
And John, from the perspective of, arguably one of the most successful real estate legal practices in the country, is there anything aberrant from all this that you're seeing in the transactional work that's moving through your firm?
I think what we're seeing, it's very consistent with the slides that you've seen today, the speakers today. And this goes back to one of the earlier questions you were asking about cap rates, is deal flow is not dead by any means, but there's been a bit of a paradigm shift in the leverage from sellers to buyers. I've seen more transactions in the last 12 months that came to market but didn't make. You see brokerage firms handling marketing of different assets different, more quiet marketing. You're not seeing anywhere near as much as the best and final competitive bid with guys jumping over each other. People are being much more cautious. The other thing that we're seeing is that some of the developers are actually buying product not really for this cycle. I have a number of clients who are buying properties now for, perhaps as Peter would do, but not necessarily for a lot of these guys who'd be buying properties for 6, 8, 10 years out. They're going to buy it. They got enough cash flow in place. They're going to let that cash flow run out. They're going to re-entitle the property and hope to come online in 22 and 23. We weren't seeing as much of that before, when people thought they could make a really great leverage return in a couple of years. In this situation where you do have a little bit closer equilibrium of pricing, you're seeing more transactions like that.